All technical analysis is based on a practical view that security prices change cyclically. Thus, there are basic tendencies, 3 to be exact, which are referred to as trends. The first is an uptrend. The second, downtrend. And the third, trading range. Further, the technical analysis is derived from historical data, in which the study of previous trends makes it more or less possible to accurately predict the course of trading in the future. Thus we can say that technical analysis is a form of trend prediction, which is dependent on trend duration. Trend duration are classified in 3 ways: primary, which is 1 to 2 years, intermediate, from 3 weeks up to 6 months, and finally, short-term, which is less than 3 weeks. It's necessary to remember that all 3 trends develop simultaneously. The initial material for technical analysis is provided by charts. The chart is a graphic representation of the change in stock prices and volume of trades. The x-axis shows the time of the quote. The y-axis shows the corresponding price. Volume is represented separately as a so-called histogram. This histogram is located under the price chart. On a regular chart, the price and time are listed proportionally, meaning that a 1-point change in price corresponds to a 1-point change in time. It is said that this kind of chart uses an arithmetic scale. The arithmetic chart has one significant fault, however. Let's assume the price of stock A is increased by 3 points, from 3 up to 6. Also, the price of stock B has increased by 3 points, from 30 to 33. On the arithmetic diagram, these changes will be displayed as equal movements. However, the reflection of an equal movement is not completely accurate. Yes, they have both increased by 3 points, but where stock A is increased in value by 100%, stock B has increased by only 10%. As such, the arithmetic scale will not reflect the changes in growth of a stock adequately. This flaw in the arithmetic scale is eliminated in the ratio or geometric chart. The ratio chart does not reflect the absolute changes in price, but rather a percentage thereof. In our example, the change in price of stock A, as represented on the ratio chart, will be seen as a 50% growth, and that of stock B will be given as a 10% growth. There are various types of graphs used. The first is a candlestick. Second is a bar. Third is a line. The fourth is a volumetric diagram. Volumetric candles. Kagi. 3-line break. Renko. And point and figure. We'll get into more detail regarding the different types of charts in the next section, but for now let's stick to the basics. Traditional technical analysis can be divided into 2 parts: visual analysis and analysis of indicators. Visual analysis is the first approach used when trying to define a trend. The name visual refers to the trader trying to find information represented in the chart by means of the look of the chart, without the application of any calculations or complex constructions. Now let's start with some basic visual trend elements. Before us is represented a classical uptrend, which is A through F. The segments A, B, C, D, and E, F coincide with the major direction of a trend and are referred to as the primary movement. The segments B, C, and D, E are short-term corrections of the primary movement and are called secondary reactions. Usually, the secondary reaction recovers to no more than 2/3 the level of the previous primary movement. If the movement is more than 2/3, it could be possible that the trend is changing. When defining trends with the help of visual analysis, the trader is seeking standard situations, or so-called price patterns. All price patterns can be divided into 3 types: reversal patterns, continuation patterns, and rectangles. Now let's take a look at how some reversal patterns will look. The first is called a trend breakthrough. The next, trading range breakthrough. Head and shoulders. Double top. Double bottom. Triple top. Triple bottom. Broadening formation. Rounding top. Rounding bottom. Descending triangle. Ascending triangle. Exhaustion gap. And island. Now let's look at some continuation patterns and how they would look. First is a flag, pennant, a wedge, and runaway gap. There are patterns which indicate transitive stages in trends. They can lead to a change in the trend or a continuation of it. The distinctive features of these patterns are the presence of support lines and resistance lines. Such patterns are referred to as rectangles. There are 2 types of rectangle patterns. Distribution area and accumulation area. The indication of a rectangle pattern ending is the breaking through of its line of support or resistance. And here are 2 examples. One is a support line breakthrough, and the other a resistance line breakthrough. The breakthrough of a support line means that there was a process of distribution behind that pattern. The breakthrough of a resistance line indicates that there was a process of accumulation. Now, volume. The indications of the volume of trades play an important role in technical analysis. Martin Pring, a well-known expert in technical analysis, came up with some important rules which demonstrate the interaction between volume and price patterns. These rules serve as a good starting point for beginning investors. 1. A solid uptrend is always accompanied by an increase in trade volume. 2. If an uptrend is accompanied by an increase in volume, but at the same time the overall volume is down in relation to its previous level, this indicates that the bears are gradually beginning to take control away from the bulls, and a downtrend is approaching. 3. If an uptrend is developing on decreasing volume, this is considered to be a major warning sign. Rule 4. If over a long period of time the price and volume are increasing moderately, and then there is a short-term explosion in the growth of both, followed by a radical drop, this signifies a major change in trend. Rule 5. If, after a long downtrend, there comes two secondary reactions accompanied by decreasing volume, the probability of an uptrend is very high. 6. If there is a change in an uptrend accompanied by a strong increase in volume, the probability of a downtrend is high. Rule number 7. If, after a sharp drop in price accompanied by an increase in volume, stagnation develops, we can expect that any increase in price will be accompanied by low volume. Rule 8. If, after a long uptrend accompanied by an increase in volume, the volume continues to grow and the price remains relatively unchanged, the distribution is high and there exists the strong probability for a downtrend to develop. And Rule 9. If, after a long downtrend, there is a sharp increase in volume accompanied by a static price, there is a strong accumulation, indicating a high probability for an uptrend to develop.